Good morning. This is Jovine from Behind the Markets. Happy Tuesday. Today is February 25th. Wow. February 25th. This year is just marching right along, isn't it? A little sore from the dentist. I have a phobia of dentists. No offense to any dentists watching this, but I'm just one of those guys where all the noises and the smells and the sounds, it's a little hard for me. Anyway, we all have our things, don't we? Anyway, today I wanted to talk about, and I'm a little bit behind on this, but it is something I put on my notes to discuss with you all. Walmart's earnings. Walmart's earnings were actually pretty good, a fabulous growth for 2024. But what they talk about in 2025 is when to set the market down last Thursday, down 500 points or so. Basically, what they're saying is the consumer's starting to show signs of hurting. So instead of 6% revenue growth, we're looking at 3 to 4%. Walmart is a great indicator for consumer sentiment around the country because they have stores in every state everywhere. They get their finger on the pulse. It's like a great economic indicator. Their finger is on the pulse of the patient as much or better than anybody in the country, like in Amazon. And they're saying that, look, we're starting to see consumers are starting to struggle a little bit here. So they're making smaller purchases. If you're Walmart, your average customer comes in once every 10 days and they buy $150 worth of things on average, then all of a sudden you start to see them come in once every 11 days and they're starting to buy $140 worth of stuff on average. You're going to say to yourself, my goodness, that's not really a good sign. So when a company like Walmart says we expect growth of 3%, that basically is the inflation rate. So that means no growth in real terms. And that tracks some of the other things that we've seen here. The Federal Reserve released a chart that I'm going to share with you that says, you can see it here, that Americans are missing debt payments as if there's a recession already. U.S. consumers now have delinquency rates are defined as 90 days or over on the credit card payments. That has jumped to 11.4%. It's the highest in 13 years. They have not risen at this pace since the great financial crisis, 07-09. These delinquencies have also exceeded 2001 recession levels. We're seeing the consumer is starting to really struggle a bit. The Federal Reserve's chart shows that Walmart's earnings show that. Now, I want you to contrast that with the stock market that we're in. Contrast that with retail investors are also buying stocks at the fastest pace on record in history. Mom and pop investors, clearly not the ones who are struggling behind in the credit card payments, but their investor flows into technology stock have more than doubled in the past few weeks. While that is happening, retail investors are more often than not, in aggregate, less sophisticated than professional investors. You look at Buffett or other institutional investors, they've been selling stocks for the past 3-4 months, a lot of stocks. Whereas how do professional investors sell stocks? We sell them when retail investors are scooping them up because that's how we get out of our positions. So it's always a truism that if you don't buy something, a stock, when it looks absolutely terrible, you'll never buy a bargain. And conversely, if you buy a stock when everybody else wants it, in the long term, you're never going to do well. You might play musical chairs and get lucky. The greater fool theory, it might keep going up because in this case, retail investors keep bidding it up. But it's not a good way. It doesn't make for a good investment strategy over time. This is a scenario where, again, underneath the surface, there are a lot of cross currents here happening that were not present in Trump 1.0. A lot of cross current. Debt, again, when Trump first came into office, debt was completely reasonable, 40% of GDP. Now it's 100% of GDP. Our interest payments are bigger than our defense budget. Institutional investors are saying, wait a minute, we don't want to buy United States long-term debt. And now we see that professional investors, the Buffetts of the world, institutional investors, folks like us, have been selling stock for the past 6 months, 4 months, 5 months. So my point to you is there will be a crash coming. There is no doubt about it. This is the nature of cycles. Cycles just go like this. They just go like this. It's not good or bad. It is neither good nor bad. It just is. It is the way the human animal works in a crowd when it comes to financial markets. It's neither good nor bad when a crash comes. The only thing you can control is how you react to that crash when the market gets really hammered. So this is a market, in my view, that is just walking on a tightrope. Professional investors, smart money has been selling. Retail investors are rushing in. They don't really understand valuation. They keep saying, hit me on 18, think of blackjack, hit me. They might be getting lucky, a few hits, but over time, that's not going to work. So we know the market is going to get hammered at some point. The question is, what are you going to do about it? So again, I know I talked about it yesterday. I urge you to get our Midnight in America book, because in that book, I write 4 steps to prepare and profit from a market crash. And what you're going to learn is how you could take a certain amount of money and make 10 times that money if you know what you're buying when the market crashes. Anyway, that's all I have for today. Have a wonderful day. I'll see you tomorrow.